had a provocative, it had a very provocative title. It was, so this is, we've just started recording. So this is, I'm just covering a follow-up to our last investing discussion group, which was, can your retirement tax bill really be zero? That was really fascinating. And, spoiler alert, zero, very tough, not impossible. I did show you one or two ways you could do it. But if you're knowledgeable about tax brackets, you would understand that like a 12% federal bracket is a lot more doable than 0% federal tax. But it was a very fascinating discussion. But one thing that, as a follow-up to that, that I was not as well versed in that I think is so interesting are donor advised funds. So I just covered them briefly, but the more I've listened to podcasts about them and read about them, it's really fascinating if you are a charitable person, but you've adopted this strategy where you're going to, for reasons of like how Social Security works and how you want to manage your tax consequences and things like that, you might not want to be having a lot of income around the time that you're collecting Social Security. And if you have a Roth IRA, that what you take out of your Roth IRA is not income. But you're kind of like in this non-tax world then. So giving to a charity, you're like, well, we all love to give to charities, but if part of your motivation was a tax savings, that would all have been eliminated. So then these donor advised funds are so interesting because earlier in your life, maybe when you have a very high tax bill, you can open a donor advised fund at any, like, a Fidelity or a Vanguard, any of these places that you're used to dealing with, and you give them a lump sum, and you get the tax write-off at the time you give the lump sum, but then you have that fund forever to disperse your charitable giving. It's really fascinating. This might not resonate with you if you're like, I don't get it. I'm not trying to do tax-free retirement or whatever. But for the people who really want to be charitable later on, but their income is high now and they want the tax benefit now, donor advised funds are just brilliant. I know my sister, I'm trying to get her to do one. She's a very high income now, but she might retire and then she would want to be just as charitable. So it's like, we'll get the benefit now. And then for years and years and years, you can look ahead and make sure you're still giving to your church and your favorite pet charity and all those things. Okay, so that's a follow-up from last time. Tonight, we're focusing on asset allocation. We're starting with the big guys, the big endowments, the top endowments, the big pension funds. And then we will drill down to you. How does this apply to you? It's not just lifestyles of the rich and famous, although it is fun to see how the smartest investors invest. This is all going to get back to what is relevant for you. Okay, asset allocation, people have written books about it. We could talk about it for hours. We probably have about 80 minutes left. Oh, 80 minutes on the dot. Yay me. So how are we going to spend this 80 minutes so that it's, the best use of your time, really impactful information, also interesting to listen to. So I would say that if you care about asset allocation, if you're interested in what the top endowments are doing, if you're interested in what pension funds are doing, everybody has to just start with a nod to David Swensen at Yale. He just revolutionized asset allocation for these big, capital allocators, big money managers. And so we're going to start with him and his contribution. And then we're going to look at some of the actually how Harvard is investing, how Princeton is investing, how MIT is investing. And then we're going to also look at the pension funds. I just picked two. I picked a big pension fund out of Texas, the Teachers Fund, and I picked, it's called SWIB. So what does that stand for? It's something, State of Wisconsin. There we go. State of Wisconsin Investing. And it's so the State of Wisconsin Pension Fund. So we'll look at that. And then we'll try to get it, it's just interesting to look at. It's fun, but then it's like, well, how's that going to drill down to you? Or how could you take advantage of this information? And there are going to be some hurdles, right? Like you don't have the same access as these investors, but there are going to be some opportunities. So we're going to talk about that. And then while I have you here, I am always, always, always pleading with people to make sure they are really, really diversified in their investments. So if you're out there and you're like, I am diversified because I own the S&P 500, please, please, please think again. So you should not let an asset allocation webinar pass you by without thinking about your own diversification and how it could be better. We'll briefly touch on rebalancing, because that's something like once you've determined an asset allocation, it gets out of whack, because some things do well, some things do poorly. So maybe the stock part of your portfolio grows, the bond part shrinks, and then you have to rebalance. So if you have a strategy, you want to get it back in line. And we can take questions at the end. We always do, but all throughout, you can leave questions in the chat. I see there are two things there already. Oh, okay. That's from Young. She was saying sorry to record 7 minutes later. You know what, Young? Just to be on the safe side for people who are watching this, I'm going to read the disclaimer again. This webinar is for educational purposes only. It is not intended to provide investment advice. None of the asset allocation strategies mentioned in this discussion group are specifically discouraged or recommended. Before making financial decisions, you are urged to consult a wide range of professionals, tax expert, lawyer, financial advisor, who are aware of your unique needs and situation. Okay, and one more in the chat. What have we got there? Oh, thank you, great. Okay, so let's really get down to business now. David Swenson. Okay, we are giving this man all the honor he is due. If you spend any time among serious investors, serious money managers, David Swenson started running the Yale Endowment in the 80s when Yale only had, believe it or not, only $1 billion in their endowment. And he literally grew the Yale Endowment to $30 billion. His strategy was totally different, and his thinking was so clear, and he was so smart and rigorous and contrarian. He was doing his own thing. So he finally, after like years and years of success, wrote the book Pioneering Portfolio Management to let people in on like his strategy and what he was thinking. The equity bias. So what does that even mean? It doesn't mean public equities, right? It doesn't, or at least it doesn't necessarily mean, okay? So this is one of his big contributions, is that if you think about investing is always, you're either giving your money to become a partial owner, or you're giving your money to lend money, right? So you're either taking like an ownership position, that's equity, or you're just lending money. So if you're lending money, you're a lender. So it's a loan, you're buying a bond, that's lending money. So what he did first of all, he was saying he has an equity bias, right? If you look, historically, even though equities are riskier, over time, equities deliver much higher returns. So if you're an outfit like Yale, and you have to make money. I mean, now all of these top endowments are such a huge part of the operating budget. The money they make is a huge part of the actual operating budget of the school, right? So whether it's Harvard or Yale or MIT, I mean, they're giving at least a third of their earnings. I mean, not a third of their, excuse me. The budget of the school, the operating budget of the school, like how is the school going to pay for itself year to year? How is it going to pay for the faculty and the grounds and everything? They're leaning on their endowments. They're getting a third of their revenue from the endowments. In some cases, it's even worse. It's approaching 40%. Some places it's a little less. But these endowments have to make money, and they have to throw off money every year for the operating budgets of the schools. So he felt a lot of pressure to make money, and he was like, the way to do that is an equity bias, right? So instead of bonds or loans, he was like, I'm going to go for equity. Now, when people think of equity, they think of stocks, they think of publicly traded stocks. He really broadened people's perspective. He's like, yeah, I'm talking about equity, I'm talking about ownership, but I'm talking about private companies. I'm talking about how do we tap in to, the growth potential of new businesses, right? Or how do we tap into when a business that's maybe languished is reinvigorated, okay? So like tap into new businesses, that's venture capital. Tap into businesses that are languishing that could be like, that could be revived by the smart operational people, right? So that's private equity. There are all these things that were going on that he was like, that's equity, that's private equity, or it's venture capital, but that's where his equity bias was hitting. It was also hitting among hedge funds, so I'll cover that later. He also really was encouraging investment in real estate, right? So if you take the 60-40 portfolio, the stock bond portfolio, and people are thinking, these are public investments. So these are public stocks, publicly traded stocks, these are publicly traded bonds. He was like, yeah, no, I mean, I'll do some of that, but really the opportunity is in the private space for equity. It's in the venture capital, it's in the private equity, and it's in real estate, private real estate. So we'll get into all of that. And then he was a big believer in diversification, right? You're not going to overweight any of these too much. And even if you're in private equity, you're going to be in several different deals that don't correlate, right? And also for him, and for endowments in general, he really was like, we have this great opportunity because we can be illiquid, right? So we have to, instead of seeing that as a constraint, we want to get a liquidity premium, right? So liquidity is all about how quickly can you get your money back. And he's like, it's okay if our money is tied up because we have this really, really long time horizon. So he walked money managers through, like, these are the ways to think about, what is unique about an endowment, the time horizon, the ability to be illiquid, what are the needs, writing a big check, this is another thing that they can do. So he was sharing all of this logic with his community, and he was also training so many people who once worked at Yale have gone out into the world and taken over the endowment in Princeton, taken over the endowment at MIT. It's really like his reach cannot be overstated. And then he talked a lot about making sure that you're being a contrarian, making sure that what you're buying, is kind of like a value investment. It's not overpriced. Look for inefficiencies. And this is where, like, his model today, I'm not sure, David Swensen passed away. And if he were alive today, would he be greatly concerned with how much money is now chasing too few deals in private equity? So he might say, whoa, I didn't say like private equity is like this dream, it's not a panacea. Like, if there's too much money floating around and you're not getting things at a good value, then you're kind of avoiding like one of the main tenets that he was trying to share. But anyway, David Swensen, responsible for so much of what we're going to cover tonight. So, let's get into it. Let's get into the asset allocation at top endowments and pension funds. And just if anybody out there is like, well, I still actually don't really understand what you mean by asset allocation. It's just, if you look at all of the dollars that you have to invest, what are you going to commit to different asset types, right? Like stocks are an asset type, bonds are an asset type, real estate is an asset type. So for some people, they just invest in the S&P 500 and forget it, and and some cash, and then that's it. But your returns and your level and how risky your whole portfolio is really dependent on your asset allocation. So let's. Oh, and also I just have to give a special thanks to Ted Seides. This webinar would absolutely not be possible without Ted Seides, who's a Greenwich resident, who actually worked for the Yale Endowment, and now he is an amazing podcaster. He had a long career in hedge funds. He's written 3 books. His first one was all about hedge funds. Then he started the podcast Capital Allocators, where he gets the absolute best speakers. The podcast is exactly what it says, Capital Allocators. If you consider like these top money managers, the people who run these endowments, they have all of this money and they have to figure out where to put it, where to allocate it. And very often they were allocating to hedge funds. They are allocating to hedge funds. And since he was an expert in the hedge fund space, he thought it'd be really interesting, to turn around and be asking these allocators like, well, how did you come up with this allocation? Or why did you choose that particular manager? Although the manager, like who picks what manager, is actually very secretive. And it's so frustrating because you're just dying to know who's, picking which hedge fund, but they don't like to tell you. Anyway, Ted Seides, Greenwich resident, not only did I listen to probably like 50 of his podcasts in preparation for this webinar, it's so interesting to listen to the people who run these endowments, whether it's running the endowment for Baylor or Rice or he had Amherst on there. I mean, it just so interesting. But also Ted was kind enough to come into the library and meet with me for an hour to cover my questions, to make sure that what we're presenting tonight, that this is the real deal. Like it wasn't just like listen to a few podcasts and figure it out. We know for a fact that we are presenting the absolute right information. So thank you, Ted. And the library, I think, will shortly have his latest book, Private Equity Deals. And he actually, his podcast, under Capital Allocators, he has created a sub podcast all about private equity deals. So if you're particularly interested in that, that's fantastic. Okay, so here we are. Forget the 60-40 stock bond split, because look at what Harvard's doing. And I was so appreciative that Harvard just shared their allocation. Like a lot of schools are a little bit, they're more opaque in their dealings. I'll show you how MIT just kind of like, in prose describes what they do, but they don't spell it out like this. But here you have it. This is the Harvard endowment. They're 14% in public stocks. They are 32% in hedge funds, 39% in private equity, 5% real estate, 5% bonds, and then I guess they wanted people to know that they're in TIPS, which are the inflation protected treasuries, which you hear a lot about now that we have inflation. So maybe they wanted to call that out as like that's something specific.
They have private equity and credit and all that stuff, and frankly, everyone's in trouble with private equity because no one's giving
public equity 14, private equity 39%.
Oh, okay. So I'm sorry. What did you have a question? Hello? Oh, I thought I heard a question in there about the private equity.
Oh, yes, that was a question. I think he just unmuted. He said there was a problem with private equity. I remember there was an article a couple of months ago in Wall Street Journal. They said, private equity didn't do well, and also withdraw money from the private equity could be a problem.
Well, we're going to get to that, because this is what happened. All these people year after year after year are piling into private equity. So David Swensen, when he started with the Yale model, he was also saying he was being a contrarian, right? He was going where spaces where other investors were ignoring. But then when more and more people adopted this private equity model, all of a sudden you have so much money chasing too few deals. And so we're going to find out, I think you're going to see more and more and more stories about private equity that's not working out. So I'm telling you what they're doing. I'm not telling you that it's the smartest strategy. It's just how the universe has evolved. So whether it's Princeton or Yale or Harvard, this is what they are doing. And I think we're going to find out, who's getting caught in something that's maybe, yes, it's illiquid, but maybe also it's not going to give these spectacular returns. But that's the big question, because it's not very transparent, and people are still piling in. I mean, this is regular investors are saying that. I was listening to a podcast that was talking about high net worth families and high net worth individuals, and they said that they wanted 40% of their money to be in private equity. Well, that's really like people chasing returns. So that can be really bad. Okay, so there's Harvard. Let's take a look at Princeton. So, and these are all very recent numbers, and you can get, if you just, look up the Princeton Endowment, you can find this for yourself as well. I so appreciate the colleges and universities that are transparent and they just put it right on their website. A lot don't. They don't really want to share exactly what they're doing. So it's interesting when something says real assets, right? So that is real estate, right? And there's also, oh my goodness, Rice University. There was this great podcast about Rice University and all the different kind of unique real assets they have that have been donated to Rice over the years, whether it's like timber or when you're drilling for oil, they have like oil wells, and it was a little bit complicated. Like they don't own the land, they just have the right to drill on the land, but it's, it generates cash and blah, blah, blah. But anyway, real assets are, like it sounds, they're very, very real. And then there's, so here for Princeton, they're 30% private equity. And then you don't see the word hedge fund, but that's basically what independent return is. I mean, sometimes it's called absolute return, sometimes it's called independent return, but it's basically these very smart hedge fund people who are figuring out ways to get basically make money. I mean, they're just an absolute return, like there will be a return. There will be some kind of, you will make money on the money given to these people. And it's not necessarily correlated with the market. I'll show you some of the strategies later, but that's what that independent return means. So again, you're not seeing, I mean, you have fixed income and cash, right? But like that's only 8%. I mean, so this is way beyond a 60-40 stock split. This is, again, you're going to see a lot of hedge fund, a lot of private equity, and then more real assets. And among the real assets are the real estate, which is something that David Swenson was very, particular about. And then you get into these schools that are a little bit more opaque. So if you look up their documents, they won't tell you exactly what they're doing. They'll say, that they're trying to, that they're broadly diversified and that they are, their policy favors equity. So, again, hearkening back to this equity bias. They invest in external fund managers. That's pretty much a clue. That's going to be the private equity, and that's going to be the hedge funds because, you don't need, your internal people can do the easier things. And, so they'll say that they're in private equity and they're in real estate, but they're not giving you actual percentages. Okay, so hedge funds, right? Like, these are, you've heard about these guys. Now, I know Ray Dalio is no longer at Bridgewater, but everybody knows Ray Dalio and his book. So I don't know exactly who's running Bridgewater Day, but it's the largest hedge fund out there. I'm sure Citadel isn't that far behind. Cliff Asness is based in Greenwich, so we threw him in there, AQR. D.E. Shaw is a hedge fund that's known for quant strategies. So, these companies are out there, and if they're not familiar to you, it's because individuals pretty much don't use them. I mean, I guess like a super high net worth family office might use them, but even then, the way hedge funds have evolved, institutions use them because they don't pay taxes, right? So institutions are tax-free, and the trading strategies or the money-making strategies of hedge funds are usually not very tax efficient. So more and more, you're only going to find these hedge funds having institutional clients, like pension funds, like these top endowments. So yeah, so what exactly are these hedge funds doing? Well, it's complicated and it's not transparent. They do try to say that they'll say, like, in general, for example, like there'll be a hedge fund that they say they focus on a long short equity strategy, right? So they're not giving away too much. They're not saying to be long means like, they own the security, they believe in the growth of the security, a handful of stocks, right? And then the short is they're betting against the stock. They think the stock's going to go down. So for a long short equity strategy, these are, very actively managed dollars that are where hedge funds are picking certain stocks, to hold long, and they're picking certain stocks that they think are going to go down. So that's shorting. So that's one thing a hedge fund might do, is have a long short active management strategy with stocks. They do things that are event driven. That's kind of language for mergers and acquisitions. I guess event driven could also be a big macro event, a big, like something going on in the economy could be event driven. Or they, it's so funny because then they'll be like, or we just have like a multi-strategy. And very often with hedge funds, what they really want to do is just what they want to do. And to the point that the head of the Princeton endowment was saying, sometimes these hedge fund guys come in, and even if they're super smart and they have a tremendous track record, you just can't give them their money, because what they're talking about is basically like a black box strategy. Like, they're just not going to tell you what they're going to do. They're like, we're really smart. We don't give away our secrets of how we operate, but we make a lot of money. And at least for the guy running the Princeton endowment, he was like, this is just getting too much. I mean, I get it. You guys are from the best schools and you have the best strategies, but you're not willing to tell me anything that you're going to do. You're not going to be specific with how you're going to make money for me. And he called it the black box, strategy. But that's, very often, like, there was a whole book written about the quants, right? So getting back to Cliff Asness at AQR and Ken Griffin at Citadel. I mean, a lot of these guys they are quants. They were just noticing, they have teams of people noticing patterns in trading and then creating algorithms that are like, oh, well, if X happens, then, do B. And that's proprietary information. It can be extremely confusing, and they don't necessarily want to tell their clients what they're doing because they don't want it getting out. They don't want it replicated if something's working. So yeah, hedge funds a lot of them are kind of shrouded in mystery, but they're the smartest guys in the room and they make a lot of money, and big institutions rely on them. Okay, so that's hedge funds. Then for private equity, at least private equity is a little easier to explain. I love, again, Ted Seides, who runs the Capital Allocators podcast. If you search Capital Allocators in your podcast and you put in private equity, it'll kind of take you to all these episodes that he did specifically on private equity deals. And some of them, it's really not rocket science. And also, I think Ted Seides has tried very hard to help people understand how private equity, like the old view of private equity of kind of plunderers or people that are kind of come in and load up a company with a ton of debt, leverage buyouts and things like that, that the face of private equity has really changed and the contribution of private equity has really changed. And so he's done different podcasts to show, like, for example, KKR, which is one of the famous private equity companies, they saw an opportunity. I mean, talk about simple. It is a company that makes fancy garage doors, right? So back in the day when people didn't make, extraordinary homes necessarily, or there wasn't this mass affluence for, or mass need for beautiful garage doors. Garage door is pretty basic, whatever. Well, then there's this company that actually does beautiful custom garage door, or semi-custom, I guess you would say, if they're still part of a manufacturing unit. And they were chugging along and they were doing an okay job. And KKR came along and was like, we know, because of all of our operational knowledge, we know how to just revolutionize this business. And not in a way that loads the business with debt or strips it or squeezes its employees. In fact, like totally the opposite. So that one podcast I thought was like, if private equity really confuses you, then definitely check out Capital Allocators and search KKR private equity deal, and it'll pop up about this garage door company that they ended up making a ton of money, over a few years, but it's because they went into the business and they focused on the operations of the business. They made the business safer, right? So they had You measure all of these things when you're trying to run a business. And the garage door company at that point had abysmal scores on safety. So I guess it was something like 14 employees per 100 were getting injured every year, which is just terrible, which is a drag on business. It's expensive. It's not safe. So then they instituted, safety policies, and they fixed that. They asked the employees like how they most wanted the space to be improved, the factories to be improved. And they were like, oh, well, we really, really want air conditioning. And they're like, oh yeah, that's kind of obvious. So they focused on all these different ways, and some of it gets really complicated. It's like, visiting Toyota plants in Japan and learning about like, the better parts of manufacturing and things like that. But instead of thinking of private equity as just, plunderers that come in and do things with businesses that are just kind of like an ugly side of capitalism, this, Ted Seides has at least 7 or 8 different examples of private equity deals where the underlying product, whether it was tailor-made golf clubs or these garage doors, the process was improved, the employees were happier, profitability was improved, everything all around was improved. And then, the company that owns, so KKR then turns around and tries to exit the deal, and they can find someone to buy the company for much more than what they paid because of all of these genuine improvements. So I thought this was really, really an interesting way to learn about private equity, and also exactly what David Swenson was talking about, that these taking an equity position and improving these companies over a long period of time, like that's where the most money can be made. And what kind of money is that? Well, obviously, if you're going to be in, not you, but like these endowments are going to be in many, many, many different deals. So I'm just going to use these numbers came from, there's a great podcast called We Interview Billionaires, and they interviewed this guy, Yusko, who was, he ran the endowment for University of North Carolina. He had previously been at Notre Dame, and he was sort of just talking about like the expected returns, right? So if everyone has to battle inflation, right? So these endowments, even if they're making money, if they're not clearing the inflation hurdle, it's like they're just going sideways, right? So he's like, okay, well, you have the risk-free rate. We can all just sit there and buy government treasuries all day, but that's that's going to keep you on a par with inflation, but then you're not really making any money. So then you go into like certain bonds, and maybe that gives you 2% more over the risk-free rate. But then if you go into like public equities, that's going to give you like a 7%, more than the risk-free rate. And then he talked about private equity, that historically it's giving you 12% more than the risk-free rate. So you can see kind of like that kind of return compounded year after year is why these endowments and pension funds and things like that are so focused on the potential for private equity. But again, like, has it gone too far? Are there too many dollars chasing too few deals? This is going to be what the future holds. Okay, so now let's look at some pension funds. So we did Harvard and Princeton and a little bit of MIT. The pension funds are different, right? So again, you're not going to just see like the 60-40 split of public equities and bonds, because they are going to have real estate, they are going to have private equity, they are going to have hedge funds. But what you see is like it's a little bit more conservative, right? It's less hedge funds, less private equity. So again, Ted Seides, Capital Allocators, amazing podcast. He did a full, hour interview with Anne-Marie Fink, who runs the state of Wisconsin's, it's called State of Wisconsin Investment Board, but most of the investment is for the state of Wisconsin pension fund. And she's very candid about what she's doing. It's a little confusing because she's in hedge funds, but she doesn't explain exactly where. So she'll say, like, she talks a lot about selecting managers and selecting hedge funds, but then she'll say, oh, she's 38% equities and 26% fixed income. And she's not mentioning hedge funds specifically, but you can have a hedge fund that only does fixed income, right? My daughter this summer worked for a hedge fund that only did municipal bonds. So fixed income doesn't mean that, like, she's sitting there just buying treasuries. So anyway, this was her breakdown. And if you're a math person, you probably noticed that it added up to way more than 100%. So how could that be? And this was interesting. And I thought unusual for a pension fund. They actually use leverage, right? So this is how all of the money is deployed, plus they borrow some money and deploy it too, which is a little bit risky. But when you find out how incredibly levered, so the riskier investors are like incredibly levered, right? So just a 14% leverage is not that big a deal. But that's why this adds up to, I think these numbers add up to 113%. And she says in the podcast that they're using 14% leverage. And she didn't say specifically that, they're specifically levered, only on the equities. She didn't go into that, so I don't know exactly how it was distributed. Okay. If you are interested in bonds, I thought it was helpful to, this is on the State of Wisconsin Investment Board website. Interesting how they're willing to look at some of it is below investment grade, but it's not like hugely junk bonds. But they're definitely willing to go down sort of the quality scale on their bond holdings, which I think can be kind of reassuring to people who want to be in bonds, that if a Wisconsin pension fund that is trying to be extremely careful is willing to go beyond like AAA rated bonds. I was definitely surprised to see like those B-rated bonds being like 8.5% of their bond portfolio. That was, to me, pretty shocking. And I don't know about this not rated stuff. So I'm like, okay, I can't believe you're in a bond that's not rated, but that's okay. Anyway, I think that's helpful for people that, because there's not a ton of yield out there, to maybe be a little bit comfortable with going down the quality spectrum, knowing that pension funds are doing that. Okay, this is not an easy graphic, but so this is the Teachers Retirement Fund, the Texas Teachers Retirement Fund. Again, an enormous fund, an enormous pension fund out of Texas. And it's interesting. They are in hedge funds as well. They're in real assets, so they're going to be in real estate, and because it's Texas, they're also in energy and things like that. They're focused on emerging markets. They definitely have private equity. They're 14% private equity. Not the easiest graphic in the world to read, but again, you get the idea that. But it is sort of like the state of Wisconsin, definitely much more on the bond side, versus these endowments that are really ignoring bonds altogether. It's kind of fascinating. All right, so private equity, hedge funds, private real estate. Does any of this really matter? Right? Like, it's lifestyles of the rich and famous, right? It's interesting to know. It might be interesting to know, so, for your career, if you're young and you're listening to this, where do you want to work? If you have a kid who's going to college, coming out of college, maybe they should go into private equity and hedge funds, since this is such a huge space. Maybe they should go into institutional investing. I mean, there are so many colleges and universities and various endowments out there. There are so many pension funds out there. So hopefully, all interesting to know. But for you specifically as an investor, does this matter, right? And it's tricky because the truth is, if you listen to these managers, and I just loved these podcasts. I loved just hearing these people who run these top endowments talk about how, the most important thing to them is like they're trying to get the smartest people to take their money, right? And so they talk about manager selection, but what really they're trying to say is that, like, they think that the best way to find returns is to work with the best people. And the best people are oversubscribed, right? So the best managers, the best companies, the people that could give them the best returns are oversubscribed. So if the top guys can't even get in, right? I mean, Princeton can get in, right? Harvard can get in, but you get down to like Wesleyan College, like they're not getting in. And so you hear the manager talking, or the endowment person talking with some level of frustration, like, hey, we're not doing any venture capital because we can't get in. And you should never do venture capital unless you're with the best folks. So that was very fascinating that they're in this super competitive world where they're getting shut out. So obviously, if they're getting shut out, then we're getting shut out. So, Ken Griffiths is not going to take my money and deploy it for me. There's also a legal issue of certain investments. You have to be an accredited investor to participate, right? So as a protection for investors, because, and this dates all the way back to the stock market crash of 1929, in I think it's 1933, 1934, 1940, there was all of this legislation meant to protect investors from, solicitation, from being told like, hey, you should invest in this. This is the greatest thing. And then it turns out to be highly risky. You lose all your money. So there are rules about who can invest, right? So there's a level of sophistication, a level of wealth that you need to be an investor. And that's called being accredited. So you've got a whole bunch of issues. Your access is limited because the best of the best don't want your money. Even if you find a good deal, you might be shut out of it because you're not an accredited investor. So we'll talk about what that is. There's also something called a qualified purchaser, but that's really, super high end. Like if you want to, you have to have $5 million and, that's to get into very sophisticated deals. So let's just take a quick look. So an accredited investor is someone who either, typically earns $200,000 or more as an individual. It's very strange to me that that is a qualifier, because there are a lot of people who earn $200,000 or more, say as a doctor, and they don't know anything about investing. So it's a little odd that just income alone would make you an accredited investor, but I guess there must be some assumption that if you're routinely earning a lot of money, you have money to lose. That income, if you're married, it goes up as a couple. Then as a couple, you can combine your income. It can be $300,000 or more. So that's a pretty low hurdle for a lot of people in Greenwich who are married, that they do have a household income of $300,000 or more. So they are accredited. Or you can have a lower income, but you have $1 million saved, not including the value of your home. So, maybe those are people who've been contributing religiously to their 401k, they're a little bit older, or maybe they inherited some money, or, however you come up with that $1 million. They don't need to meet the income requirements. They just need to have the asset requirement. And then more recently, to capture people who maybe don't have the income and don't necessarily have that savings. They could have $700,000 in savings. There is this whole new thing, which is you can take a FINRA exam. So FINRA, like if you have a stock, if a stockbroker at Merrill Lynch or any of those guys, like they had to take the Series 7. I mean, there are certain exams that you have to take to show you're qualified to work in the industry, and FINRA administers those exams. What is financial regulation? I can't remember what FINRA stands for. But the Series 7 is what the brokers take. The Series 65 is, so if you have a registered investment advisory group, the Series 65 is what the people who work in that group who recommend investments, they have passed the Series 65. So it's interesting now that anybody can take that exam, either can take the Series 7 or take the Series 65, just to prove that they are a sophisticated investor, because they want to do investments that require being an accredited investor. And that's relatively new. So it used to be that you either had to have the income or you had to have the assets. And now there's this other thing where you just kind of prove you're worthy by passing an exam. Okay. So David Swensen, who initially wrote the book that was really the book for people within his industry, eventually wrote a book. People were really clamoring. He got so famous, like, well, how about me, the individual investor? What do you have to say to me? So he finally addressed those questions. Obviously, it's completely different, right? If you're running an endowment like Yale, I mean, you have this very long time horizon. You have this enormous pool of capital. You can reach out to the very best minds in the business. They will, what they call these external managers, right? Which we're saying you don't have access to. So David Swensen's team, a lot of what they were doing was really searching for talent to give their money to. And we can't do that because no one's going to take our money. Like if someone's super talented, they want, millions from Yale and Harvard. They don't want like my $5,000. Okay, but David Swensen, he really, really tried to think like an individual investor and like, what do I have to say? And the equity bias is just consistent, right? He's like, it doesn't matter if you're an endowment, it doesn't matter if you're an individual. Over the course of a long period of time, equity positions pay off so much better than like loan positions, right? So, buying a bond versus buying, or bonds plural versus stocks plural. He also is a huge believer in real estate, on the endowment level, but also on the individual level. So he's like, okay, well, that hangs together. Like I can safely say to people, have an equity bias, be in real estate. I can safely say to people, you really need to be diversified. Like this is all just generally good advice. Then he gets very cautious because he's skeptical that the average person can really navigate all the treacherous things that can go on in investing in terms of high fees, being misled, not really understanding your risk tolerance until it's too late. So people will say, I have a high risk tolerance, and then they watch their portfolio go down 20%, and then they sell in a panic, and that has disastrous consequences. So in his, unconventional success, where he was just writing to individual investors, he's just extremely cautious that, like, please don't try this at home sort of thing. Like, yes, you should be in equities and you should be in real estate, but just be careful because you're going, you might not have the tolerance for the losses that are just losses on paper, really, like when stocks decline. It's just a paper loss unless you do something about it. He was also very concerned about fees. So I think he wrote Unconventional Success in like 2009-ish. I don't know, maybe Young will look that up for me. When did he write Unconventional Success? But that was before. I mean, now like everyone's on the fee bandwagon. So everyone is super, super careful about fees. But he was really concerned about investors getting slaughtered with fees. He was really concerned with people chasing returns, which happens all the time, right? I mean, that was the whole .com bubble. That was, things going on with buying, piling into Bitcoin, and then Bitcoin lost 65% of its value.
What do you want me to search?
When did he write Unconventional Success? Can you look that up?
Unconventional Success. Okay.
Yeah. Because I think he was really concerned about fees, but a lot of fees have come down dramatically since like he wrote about it.
1 second. Okay.
Yeah. And then he was very specific on bonds. He was
published on August 9th, 2005.
Oh, 2005. Okay. I thought 2009, 2005. All right. But, almost 20 years ago when fees were a heck of a lot worse. And then he was very specific on bonds at the time. It's 20 years ago. Does it fully apply? But he was very negative on corporate bonds because he was like, the way they structure them, even if it has a good yield, like then the bond is probably callable, meaning that the company at any time can just pay you your money back and kill the bond. Like you won't own the bond anymore. So he's like, you're hardly ever in a good position because even if you get a good yield, the company can yank it from you at any time and just give you your money back. So that's, a bond being callable. So he spends a lot of time talking about how you should pretty much just stick with government bonds. So that was his advice for investors. So let's take his advice and also figure out like what can we really do, accredited or not accredited. And so, over and over again, you hear about real estate, right? And the tricky part is, hopefully you're somewhat familiar with this, but, public real estate in the form of REITs. So these are publicly, real estate investment trusts. They're traded just like stocks. So if you think like, oh, I want to be in rental apartments, or I want to be in public storage, or I want to be in shopping malls. You could buy any of these tomorrow. The problem is that they don't really get you diversification because they just don't act like private real estate. They act like very similar to the S&P 500, very similar to other stocks. So I plugged in all of these REITs and then I just compared them to the S&P 500. And it was like they move exactly the same, right? In fact, they either kind of like move the same or they do worse. So being in real estate is not really solved by being in REITs. And hopefully this isn't totally new information to you, but what there is a trend in is there a rise in sort of online private options. I'm sure a lot of people have heard these like sort of TV or radio commercials for Fundrise. Who knows? They don't have enough of a track record yet, but they do give you a way to be in private real estate deals, and they have some of the lowest minimums. And I'm not really sure how they're getting around the accredited investor necessity. Realty Mogul is similar. I'm not recommending any of these. I just wanted something other than Fundrise to show that, I'm not pushing Fundrise. But again, like, real estate offerings to non-accredited investors so that you can get beyond just the REITs. But really, like real estate, like private real estate deals, once you start to look for them, you actually kind of find out that they're everywhere. Certainly if you have a financial advisor, you have a registered, so if you work with an RIA, a registered investment advisor, the people who do that are very capable of sort of helping you find deals. That's kind of part of what they offer. Or you can have someone, it's just amazing the things that are out there. A lot of these deals are like, well, doctors, all get together and they realize that they don't know what they're doing. So then they try to find, some kind of fund manager that knows specifically how to help doctors. And so, for example, like this guy, Thomas Black, his entire investment company is just helping doctors to make private real estate investments. And I'm such a podcast listener, but there were people who could help you with real estate. Like if you were an engineer, it's like all the engineers, it's like the engineers like to talk to people who used to be engineers who now do real estate deals, and they can get you into different real estate deals. So it's amazing how these opportunities are out there. But, in this case, you would have to be accredited, and I'm sure the minimums would be like a $10,000, $20,000 minimum. And okay, so I just want to, so private real estate deals are out there. You could also, you could partner with your friends and put together a deal all to yourself. Maybe not in Greenwich, but a lot of people, they leave Greenwich, they go, I have friends who've gone to different college towns where it's a really good idea to kind of like buy an old house and rehab it, because then it can be rented by students. And, maybe something like that, you get a few partners together and it's only, each limited partner kicks in $100,000 and then, you own the underlying real estate. I mean, this is what people do. It's very, very interesting to have like your toe in real estate and not everything is just public stocks and bonds. So another idea, since we do not have access to venture capital, so a lot of these endowments, they're going to the best venture capital companies out there, right? And even the smaller endowments can't get in, don't have access to the best of the best. So one thing that I am fascinated by are these angel investor groups. I actually go to the Angel Investor Forum meetings. So that's kind of like the very classic angel group. This is in Connecticut, the Angel Investor Forum, and you have to be an accredited investor. But this group has, reaches out to the entrepreneur community. They have people come in, and so they do a lot of screening, right? So they might screen 40 companies and only allow 3 to come present. But once a month they get together and then they screen these companies. They have 3 or 4 companies come and present, and these companies are trying to raise money. And these are viable companies that have kind of a growth plan and need to be funded. And so angel investing is sort of the individual investor's version of venture capital, right? So you do have to get over that accredited hurdle, right? You have to be accredited. But then if you join up with one of these groups, then sometimes they'll have a fund, like the Angel Investor Forum has a fund that, so they're going to fund maybe 20 different deals, and then you can be in the fund for $35,000, right? Or you can just spend $1,000 to join the angel investor group, come listen to who pitches, and then separately just, pick the ones that you like and give those companies like maybe $10,000, $15,000. 10,000 is the lowest I've ever seen. I have Tidal River in here as well, because I know that's all female, and I don't think it's because they only fund female founders? I don't think so, but at least it's an all-female group, and they also have their own fund. So if you're kind of more interested in that vibe, you can Google Tidal River, and that's another Connecticut-based angel group. Or if you want to, you don't have to stick to Connecticut either. You can expand beyond that to, so the Angel Capital Association, that's kind of like the national group of angel investors. And they say, like, here are the largest angel groups that are part of their network. So you have New York, you have Boston, Irish angels. I didn't even know they had like themes around ethnicity. Okay. Golden Seeds is this angel group that one is just for female founders. So there are all these different groups that you could join, and that could be like your version of private equity, venture capital, things like that. Okay, and then if you're not accredited, this is really interesting. So the regulation crowdfunding. So it used to be like you could not get into any of these deals. You could not be giving money to a startup company in exchange for equity. You could not do that unless you were an accredited investor, or there's this whole other friends and family thing that a startup person can do for the first like 35 investors that lives outside of this. But if you're actually just trying to get to invest in upcoming businesses and you're not the first 35 friends and family, you were locked out if you weren't an accredited investor. Now there's regulation crowdfunding, where you can actually look at a lot of startup businesses and decide to, in some cases, invest as little as $100. It's a little confusing because the Securities and Exchange Commission is trying to, give you an opportunity, but also protect you. So what they did with this crowdfunding is there's a middle entity. So there's a website, there's an online entity that is going to pair you, like it's going to show you opportunities, but then also take your money and make sure that the companies that you're giving your money to are legitimate and following certain guidelines. So there's this intermediary, right? So here, like, for example, there's this, you could just go to WeFunder, right? Just type in WeFunder in your computer, and it's invest in founders, building the future, get equity, front row seats to the startups, small businesses you love for as little as $100. So WeFunder, Republic, there are a bunch of these kind of crowdfunding companies out there where they're going to pair you. They're going to showcase startups, And you can click on the ones you like, and you can invest in the ones you like. And there are some rules based on your income, right? So there's a cap of how much you can invest that's based on your income. But anyway, this is relatively new. It's kind of interesting. It's kind of fun to go on these sites. And, some of them are just as simple as like food trucks, cute, like, I don't know, Mexican food trucks in California. I've seen all sorts of things on these sites. But they're legitimate. I mean, the SEC is behind, monitoring these, and it's cool. It's a way to get in. All right. Another interesting thing for opportunities for you is that private equity firms, I mean, they're private equity. So you would think, what are they doing looking at public companies? But a trend now is private equity firms looking at unloved public companies. Why would this happen? Well, in 2021, you had an extraordinary number of initial public offerings and SPACs, which I'm not going to get into how they're different from initial public offerings, but you basically had the public markets flooded with new companies. And a lot of those companies have just crashed. At least the stock prices have crashed. So you are not restricted in any way. If something is a publicly traded company, you do not need to be an accredited investor. And if you have all of these online brokerage accounts now, like you're not even going to pay a commission, and you could buy something, you could buy one share of stock. So you can be looking at these public companies the way private equity firms are looking at these public companies. I'm spending a lot of time on this. I think it's really interesting. So knowing that private equity companies are feeling tapped out, feeling there's a lot of money chasing too few deals, there is a whole opportunity with these companies that maybe they never should have become public. Maybe there was too much hype. I mean, you have so many companies now that debuted at like $18 and now they're trading for 70 cents. I'll give you an example, because you've probably heard these radio ads, Select Quote, right? So if you need term life insurance, nothing could be simpler, right? You need term life insurance. You got married, you had a kid, you don't want to do fancy life insurance. You just want to make sure that if something happens to you, your spouse gets $500,000. You just need term insurance. Well, if you listen to the radio ads, it's like, go to Select Quote, and they will shop around and get you the best deal, based on your age and your health and your term of your insurance and whatever you need. And so Select Quote, was an IPO, and for reasons I guess the company has some problems, but it's a well-known kind of okay run company. The stock is down to $2, right? Well, that's interesting. I've always followed those radio ads. So I'm like, oh, do I know for sure that that's something that a private equity firm would look into? I don't know for sure, but it just follows that whole pattern of all these companies being pushed out in 2021, and their stock prices have completely crashed, but they're viable companies. So it's very interesting to me that private equity now is saying, well, there is this whole universe. I mean, technically we don't do public companies, but there is this whole universe. And actually the way a lot of this started was, like KKR taking Nabisco private. So Nabisco was public and the private equity firm decided to take it private. So it's not that strange that private equity firms are now creating whole divisions looking at public companies that should be brought private. And maybe you could get a jump on that. I think it's very, very interesting. Okay, I'm going to stop for a second, because before I give my avoid false diversification speech, I do want to see, we've covered so much. If there is any question out there, I'm just going to take a quick peek at the chat.
There are 2 comments.
I thought Harvard was having a bad earnings rate this year. Okay, well, what I just read, they're not owning up to it. So maybe you read something that is even more recent, because I did not see that. They were like, yeah, everything's fine, okay. I mean, it was their like letter to the board or whatever. My understanding is Yale is doing well, not Harvard, and the difference seems to be employees versus using SMEs. What are SMEs, I wonder?
Subject matter experts. That one is using internal and one is using external.
Oh, well, that's
to manage
interesting.
to manage. I think it was on
Okay.
Bloomberg or something I was listening to.
That is really, it's really interesting how like the guy at the teacher's pension, he has a huge staff and he's so proud of his huge staff and he sees it as such a benefit. But then you listen to these other podcasts and these endowment managers are like, yeah, the whole ball game is selecting external managers. And like, that's how you make your money. So it's a little confusing to me. I mean, like, in the one sense, you hear both. Like, is it having an internal staff that's really smart, or is it only using external people that have, the specific expertise? So I don't know. I know that Harvard did horribly. I mean, like the whole Yale did so well and Harvard did so poorly for years over the fact that Harvard got rid of, they didn't like how the endowment group was being compensated. So the Harvard endowment was doing really well, but there was a lot of bad press because the people working at the endowment were making a lot of money. And so they were forced out, and then Harvard did really poorly. But I thought that ship got righted, but maybe not. Maybe your information is more recent than mine. Okay, so any other questions? Let's see, new messages. Oh, why try to beat the market? How about an ETF that tracks the total market? Right, I mean, that is right. Hello, yeah, the most basic advice is, do not try to beat the market. This is not a beat the market part. This is a, like, whatever your stock allocation is, of course, it's totally good to just do an index fund, just do some index that tracks the whole market, which leads really well to the next thing I'm going to tell you, because I want to make sure you're tracking the whole market and not just the S&P 500. This is asset allocation is, okay, well, that's stocks, right? So that when we talk about the market, we're talking about public stocks. But shouldn't you have other things like real estate, like bonds, right? And it's interesting because they always say, well, you can't beat the market. And they trot out all these studies saying you can't beat the market, but they're only talking about the stock market. The bond market, it turns out that active managers actually do better for you. So if you're going to have like bonds, then it's like, should you have a bond portfolio, like from, go to a mutual fund that focuses and has like bond mutual funds. That's a whole other discussion about like tax consequences and things like that. But those active managers in bond funds actually do beat the overall bond market. But you're right, if we're just talking about stocks, just buy an index. But leads me to my next thing. Please do not think that you are all set if all you've done is if you bought the S&P 500. So let me just quickly do that. I call it false diversification. So this is what you think you get, right? Like when I first heard about the S&P 500, I loved it. I thought it was brilliant, right? Because look, who doesn't want to own these companies like Starbucks and FedEx and Home Depot and Zoom and Walmart and Ford, Excellent. But almost all S&P 500 funds, whether you're going through Fidelity or T. Rowe Price or Vanguard, they are what's called cap weighted. So this is what you think you get, but this is what you really get, right? So the stocks that are doing well become overweighted. It's kind of a vicious cycle. So as a stock grows, the investment vehicle, by its own rules, has to own more of it, right? So as Apple's price rises, the investment vehicle has to own even more Apple, which makes Apple's price rise even more. So this is where you get the Magnificent Seven. I'm sure you've heard of the Magnificent Seven. Yeah? Did somebody? Oh, no. Okay. So because of cap weighting, if you're in an S&P 500 fund, what you're really getting, 30% of your fund is just Apple, Microsoft, Nvidia, Meta, Amazon, Tesla. I mean, it's just those. And you're getting almost zero Zoom and the Hartford and Kellogg and FedEx. So you're not diversified. You are actually incredibly overweight the Magnificent Seven. And this really, really, really bothers me. So if you get nothing else out of this webinar, please, you've got to do something other than just an S&P 500 fund, right? And there's so many things you could do. You could do, so there's the Russell 2000, okay? The Russell 2000 is it's a little confusing. You start with the Russell 3000, so the 3,000 publicly traded companies, and you get rid of the top 1,000, right? So now you're just going to take the bottom 2,000. So those are mid to small companies. Well, the Russell 2000 is great because now you're in equities, but you're not overweight. You don't have these mega caps. You don't have these enormous companies. So if you're going to be in the S&P 500, don't think that you really have diversification. You are wildly overweight a handful of companies. And you should look at things like mid-cap funds. You should look at things like the Russell 2000. You should look at foreign companies, right? I always thought this chart was fascinating. If you look at the top performing stock markets, most people would think that the US is the top performing stock market, but sometimes it's Austria, sometimes it's New Zealand, sometimes it's Canada, right? Look beyond our borders. You want to be really diversified. And there's a mutual fund, there's an index fund. Someone says ETFs. People love ETFs. ETFs make me a little nervous because I don't want you day trading these. These are important decisions, right? Like, I know ETFs are tax efficient, so that's a whole other, but think about funds. Just think about funds because you won't open your phone and sell it like the minute the market goes down. That's what I like about funds. But then you have to make sure you're in a tax, like a tax deferred account, because ETFs are more tax efficient. That's a whole other story. But if if this is in your 401k or IRA or Roth IRA or whatever, think about owning a fund rather than an ETF. And yes, again, foreign companies, right? Let's do this. Let's think beyond our borders. Let's get really diversified. And then last but not least, rebalancing. Okay, so you figured out that you're going to be in real estate, you're going to be in large cap stocks, you're going to be in small cap stocks, and you're going to be in international. So you're just going to do 25% on each. Well, some do well, some do poorly, things get out of whack. All of a sudden, 30% of your portfolio is the real estate, and you're like, okay, I gotta get that back into balance. So this is how you sell high and buy low, right? So the thing that has done well, that has grown, you trim it so you capture some of those gains, and the things that have done poorly have gotten smaller, but you buy more of them because that's how you're buying low. So that's the whole point behind rebalancing. It's kind of fascinating. So we're going to remember to do that. We are really, really out of time, but almost. But in November, the next webinar is your investing checklist, where we're not going to do lifestyles of the rich and famous. We're not going to talk about endowments. We're just going to talk about you and your time horizon, and tax efficiency and tax consequences are a huge issue. What risk profile really is, and do you really? A lot of people say that they're willing to take on risk, but I'm going to give you some specific examples. Like, could you have, if you bought Meta, which is Facebook, if you bought that at $500 and it went down to 90, how were you feeling? It recovered. It completely recovered. But this is like, when it comes to risk, you really have to ask yourself what you can endure. And we'll just do a whole bunch of things for the investing checklist. And that's November 12th. And if any of this was super confusing to you, my book is a starter book. and it's your lively, jargon-free guide to getting started. So I really explain like what a stock is. I give examples of specific bonds, like a Starbucks bond, an Apple bond, a government bond, how you buy them, how they're valued. So especially if you're just starting out or any of this was confusing to you, you might want to just go back to the basics. And the library has a bunch of copies of my book. And it's also on Amazon. Anyway, do we have any more questions? You could unmute, you could put it in the chat. You've been great. This has been fun. Really appreciate it. Love doing these webinars. If you have any suggestions for topics you'd like to see us cover, we can weave it in. We have lots of webinars to go. And yeah, I'm going to just look at the chat to see if there's anything else. I understand there was an ETF launched this week that is the S&P 500, but excludes the Magnificent Seven. Oh, fabulous. Yes, I've heard about I've heard all sorts of things. I've heard, I mean, there is, I don't recommend it, but there is an S&P 500 fund that isn't cap weighted. So it's just equal distribution, but there are a lot of reasons why that maybe isn't ideal. And then I've heard that there's an S&P 500 fund that has no technology. It's X of technology. And then I've heard there are S&P 500 funds that can be X anything. So get rid of anything that you don't like. Get rid of the financial piece. Get rid of, the technology to me makes the most sense because those are what's really overweight. But yeah, that's cool. And actually that makes a lot of sense. Just get rid of the Magnificent Seven and then you'll have your FedEx, and your Kellogg and your Campbell's Soup and all those great companies. So good to know. Good to know. All right. Any other questions? Well, you have my email.
Question. If you buy a stock that's listed on an exchange, you can always find out what it's worth. What happens if you invest in something that's not listed on an exchange?
Right. So that's very tricky, right? So you have to, how do you know what it's worth?
That's the question.
Yeah. I mean, so these private equity deals, they're coming up with certain valuations. Do you agree? Do you believe? I mean, you'd have to do your own sort of research of like finding what is public. So they call it PME, public market equivalent. So whatever you're thinking of buying, there is a public market equivalent, hopefully, right? I mean, even if you're buying, a piece of real estate that's like, I love buying distressed real estate. So it's like you buy something and you think, once this house is fixed up, I know all the other houses on this block are selling for, $360,000. So I'm starting with some public information, right? And then working backwards from there. But I mean, I think this is why David Swenson says, don't do any of this if you don't consider yourself a sophisticated investor, because you're going to have to be doing things like that. You're going to have to be looking for clues in the public stuff to figure out what the private stuff should be worth. And do you think you have that skill, or do you think you could rely on a financial advisor who has that skill? It's a good question. So PME, public market equivalent, is what you're encouraged to find.
Thank you. It's not only the research, it's also the time that you have to invest in this. And while you're investing, the commodity is not standing still.
Yeah, I say all the time, the most important thing to do is invest in yourself, right? So like I have two friends, they're both surgeons, and they shouldn't do any of this stuff. I mean, what they can make, their hourly rate being surgeons is so high, they'll never make it up by dabbling in any of this stuff. So, they should hire a financial advisor. They should trust other people. They should just go into public markets. I mean,
and yeah. I'm going to read your book.
Oh, thank you.
You're so welcome. So your programs are on Zoom every month.
So we might go back to in-person at some point. Before the pandemic, a lot of library events met in person, but then in the pandemic, people got so used to being able to participate just by Zooming in. So right now we're meeting on Zoom. The next one is November 12th. And yeah, but it'd be fun to go back to in person. Maybe we'll see after Christmas if people want to consider that.
Thank you.
Thank you too.
Thank you, Kristen. So next time we can do a survey, see how many people want to do online. We did one in June, that's why we decided to stay online. Okay, thank you very much, and see you next month.
Okay,
Bye-bye.
thanks, Jan.
Thank you.
Good
Have a
night.
good night.
Good night.